Hey everybody, I wanted to talk about inflation. Now we went through a bout of inflation. We raised interest rates. It appears inflation has gone away a little bit, but we do need to understand the two main types of inflation that are out there and what to do if we do see more of it. Because inflation might not necessarily be over, okay? So we have seen lots of fits of inflation. It comes in waves. And so the feds are talking about lowering interest rates, and maybe that's because they do see future of possible more fits of inflation, and they know it's painful to rise interest rates. So they want to give themselves some room to rise those interest rates. So let's talk about the two types of inflation. Excess demand. This is taught in grade school, right? Supply and demand. If there's way more of the demand than there is supply, then the entity selling it can certainly raise those interest rates, causing inflation. Think about the cost of the hot tech cell phone and things like that. You can very easily track that back to supply and demand. You create this huge demand, you limit the supply, you raise the price. We've seen a lot of that game happening out there, especially in the tech world. But that's not really necessarily the big picture. So let's think more about the big picture. What contributes to this type of inflation? Well, lower interest rates leads to increasing borrowing spending by households and businesses. Think about this. For the last 20 years, interest rates have been nothing. We saw interest rates on 30-year mortgages for houses get down into the 2s and 3s. 30-year fixed interest rates in the 2s and 3s. That makes it cheaper to buy a house. So now we saw housing prices go up and up and up. You think about this economically, when we have these lower interest rates, it's cheaper to borrow. Businesses, they expand by borrowing money. You look at even simply the small farms, they're going to buy a piece of equipment because it's super cheap to pay the payment on it compared to pay the labor. So now I have a really expensive piece of equipment that I borrowed money to buy, and it's cheaper than paying the wages of 10 people. And that's why low interest rates creates that more demand, more purchasing power out there, and more spending. The other thing that contributes to this, government policies like fiscal expansion, or what we mean by that is handing out free money. Here's candy for the kids. Everybody gets a free check in the mail. Remember when that happened? We all got lots of free money. Well, that's one of the reasons that we'll see inflation. And then increased consumer confidence due to economic stability, prosperity. Okay, what does that mean? Well, look, if we all feel good about our financial position, we're going to go spend more, meaning we're going to consume more. And for the last couple of decades, we consumed, and the government handed us free money. We all knew it was going to lead to inflation, but when it came, we're like, oh, what happened? No. What contributed to the inflation? Well, how about all of those things like handing out free money? That, of course, is going to lead to inflation at some point. It's not a direct cause and effect. It's an accumulation over time. So this is one of the big ones here, supply and demand, right? Demand exceeds supply, prices raise, we have inflation. So what do we do? Which investments benefit? Well, think about that. Think about our stock market for the last 10 years leading up to this, all the free money handing out, all the money. Trust me, businesses got more than the individuals got in terms of government free money. So growing the businesses, there's more demand. People are consuming more. People are buying more. So equities, especially ones that sell to those consumers that are spending all this money, are certainly going to rise over time. So how do we invest? Well, stock market is part of it. Keeping up with this type of inflation, you've got to have that stock position leading up to those inflationary times. Real estate, obviously real estate did extremely well for a long period of time. We hit that inflation, they raised interest rates. Real estate, luckily, has just kind of floundered sideways. A little bit of pullbacks here and there, but it's been much more resilient than a lot of people thought. Which investments suffer most? Well, bonds, right? If we see inflation, the feds rise interest rates, the value of all your bonds goes down. Direct reaction, period. You saw it in 21, 22-ish. Your bond portfolios all dropped in value. They haven't come back. They're not going to come back unless we drop interest rates back to zero again. Okay. Mixed results, the floating rate securities that are out there, you got to be careful with this stuff because yes, they're quick to react as interest rates rise. You're going to make some more interest on there fluidly as those interest rates rise, and that's a good thing. But at the same point, those that are borrowing money as interest rates rise, they have to pay higher rates. It's going to hurt their companies, and we see higher amounts of default. So be careful about those floating rate securities. All right, the second type of inflation, cost push inflation. This is really the costs are pushing the reason for the inflation, rising production costs. Okay, and it's funny, we educationally look through this and we look back and we're like, oh yeah, we did this to ourselves, right? So the cost push inflation. Well, this is again the resulting of production costs, raw goods going up. Okay, and there's lots of reasons that this happens. So think about even just a basic restaurant. You go out to dinner, and if the cost of food goes up or the cost of their rent goes up, then they're going to then subsequently raise the prices on their menu. Or the sneaky thing the food companies do, they make the portions smaller. They keep the price the same, but they make the portions smaller. So we see that on a micro level, but on a macro level, think about oil prices, right? That's the easiest thing we can go to that we've experienced recently. Oil prices rocket. Well, everything from trucking goods across the United States, all those big semis you see out there on the freeway costs more. So delivering goods is more expensive. The making of goods go up as well. We have a pandemic. It ruins the supply chain. It's now harder and more costly to get these items. So we know how this works. We know where this comes from. It's supply chain disruptions. It's war. War causes this, right? Now we can't get grains out of a certain part of the country, or the supply has been decreased in oil, the supply because of production. So there's lots of reasons and normal reasons that this type of inflation occurs. And I think we look back, we had both of these types of inflation occurring to us. So what do? Well, first of all, when we see this type of inflation, cost-driven inflation, commodities are typically going to do well, right? Think about oil prices. When oil prices go up, it's much more profitable for those oil companies owning those types of commodities. When we see that skyrocketing cost is always a good thing. It's just a roller coaster, so it is a little bit difficult to time all of that. Right? So commodities are always going to be good. Stocks in the companies that are involved with those commodities, energy stocks, materials, things like that, we're going to see more profitability out of those. Which investments suffer? Well, so the companies that are affected by that pricing structure, the end goods usually are the ones that are going to suffer. So we do have to be careful about owning the stocks that are selling the end goods. But also, what happens when we see inflation? We raise interest rates. You should not be in bonds. Okay, anytime we see inflation, bonds are your worst enemy. If interest rates are very low, you get out of bonds. Period. That's the only way you handle bonds. You shouldn't be in bonds if interest rates are low. And when they raise interest rates at any time, those bonds will hurt. And then once again, those floating rate securities are going to be an issue. They are helpful as we raise interest rates, but then default rates increase because it's too much pressure on the companies, and then they fall apart. So be careful in those floating rates. It's mixed results. Sometimes you're going to see some good stuff. Sometimes you're going to see it good and then rapidly decline very quickly. So be careful about that. All right, I hope that helps. So a little bit of economics and investing put together in one. So understand that we're always here to help out. We can talk about economics. We can talk about investing. Always happy to help. 2024, we've got our full classes coming out, broadcast over Zoom. So go to our nonprofit website, fpfeaz.org. And if you want to meet with me for any reason, we are launching the new website, yourinvestmentcounselor.com. Feel free to jump on there and look at the ways that you can meet with me and schedule an appointment anytime you want. If you like this education, send it to friends, tell people about the YouTube page. If you haven't subscribed, please do. And we've got new stuff coming out every single week. We will see you soon.